So friends, the question is how to improve EVA. So before we answer how to improve EVA, let's become aware that in any and every M&A deal or any corporate restructuring transaction, what is in the bottom line? Bottom line, in the bottom line, what you have is how this transaction can improve the economic value added of this business. And why is EVA a driver for all the M&A deals all over the globe? That is because people understand it very well that if a company continues to give negative EVA, that company will close down sooner than later. And therefore, having made all the efforts, if the management of an organization come to a conclusion that it is not possible for them to turn the EVA into positive, they realize that instead of continue to bleed and die one day, let us sell this company off to someone who is able to turn this company around and start making profit out of it. So what is EVA? It is basically return on capital employed minus the cost of capital employed, which is also referred as WACC, weighted average cost of capital. So now what companies would do, or what companies would consider while taking into account the M&A decision? They would take into account, number one, to do everything possible to improve the return on capital employed, ROCE. Number two, to do everything possible to reduce the WACC down, or to reduce the cost of capital employed down. So both are same, whether you call it WACC or you call it cost of capital employed, both mean the same thing. Ideally, what you should do both. So as a company which is running into difficulty, what that company would aim to do, that company would aim to achieve both the things. On one hand, company will do everything possible to raise the return on capital employed, and on the other hand, the company will also try to bring the cost of capital down. And that is why you would see a lot of companies will many times will engage in restructuring of the capital structure. And why are they trying to restructure the capital structure of the company? And that is primarily with an objective to achieve the lower cost of capital employed. Now, ideally, you should do both. But the question is, what if you're not able to do anything? What if you're not able to do either? Neither you are able to increase the return on capital employed, nor you are able to bring the cost of capital down. If you are not able to achieve both of them or either of them, then what is the option that you have? Then really speaking, you have no option. And why you have no option? Because you're not able to increase the return on capital employed. You're not able to bring the cost of capital down. That means what? That means year after year, you will continue to earn a negative EVA. And if you continue to earn a negative EVA year after year, what is imminent for you is closure of your business. So what you do, if you're not able to do anything, then what can be done is sell that company to someone, right? Sell that company to someone. So please remember, more often than not, in all the M&A deals which are done anywhere in the world, what is the driver? The driver is EVA. If a company is not able to turn the EVA of its company, then what that company will do? Try and find someone to sell that company. But here you have another question. And that question is, if your company's EVA is negative, then why will somebody buy your company? अगर आपकी कंपनी नेगेटिव ईए जनरेट कर रही है, तो क्यों कोई आपकी कंपनी को खरीदेगा? Why will somebody buy your company when your company is having negative EVA? And let me throw this question once again open to all of you.